Today we are looking at what is, I think, one of the most fascinating balance sheets in corporate history.
We really are. We're talking about Tesla's cash reserves. Just an incredible figure, $41.6 billion.
Yeah, a mountain of cash.
And, an amount that big forces everyone, the whole market, to just throw the old story out the window.
Absolutely. So the conversation isn't about can this company survive anymore. We are way past that.
Way past it.
We're now looking at an AI and an energy giant that just happens to use its car division to collect data. So for you, the mission of this deep dive is to unpack the three main ways Tesla could deploy all this capital in 2026.
And these decisions are critical. They really define the next 5, maybe 10 years for the company.
And the timing here is everything, right?
Exactly. The reason we're talking about this right now is the upcoming earnings call on January 28th. That is, without a doubt, the most important event of the year for them.
Because that's when we get the guidance.
That's when we get the 2026 guidance. It's the roadmap for how they're going to spend this war chest. The market is just holding its breath.
Okay, so let's set the stage. Before we get into where the money's going, we have to understand the reaction to the most recent numbers. Because at first glance, there was a little bit of bad news in there.
A tiny bit, yeah. But the reaction was anything but bad.
Right. So the facts. Q4 2025, vehicle deliveries hit 418,227. The whisper number on the street was closer to 422,000. So a slight miss.
And historically, even a tiny miss like that would have sent the stock down. You'd expect, what, a 300 or 4% drop?
For sure. But that is not what happened.
No, and that tells you everything about this narrative shift. The stock actually rallied 2%. It closed at $445.01.
So, Guy.
The insight here is that the market is now valuing the company as a sum of its parts. The car story is kind of stabilizing, maybe even slowing a bit, but that's just being completely dwarfed by the energy story.
Which is just exploding.
It's exploding. Let's talk about the scale, because I think people really miss the magnitude of the energy business.
Let's do it.
We have to look at gigawatt hours, GWH. In Q4 alone, they deployed a record 14.2 GWH of energy storage.
That 1/4 is enough to power millions of homes for a day. It's huge.
It's immense. And for the full year, for 2025, they hit 46.7 GWH.
So they're almost a utility company now.
That's a great way to put it. The main takeaway is that the energy business is now a cash printing machine. I mean, it's so profitable, it's basically subsidizing the entire company's transition into being a real-world AI player.
It's fueling the R&D.
Exactly. And that's why this $41 billion cash pile is so important and why we have to look at strategy number 1.
Okay, strategy 1, the big one for growth. Massive capital expenditure, or CapEx. So for anyone unfamiliar, this is just money spent on physical things, on infrastructure. You're building the future.
Right.
And this is where the AI story gets really, really interesting.
This is what some analysts are calling the AI Manhattan Project. And management has already signaled that CapEx for 2026 is going to jump a lot. We're talking well into the 10 figures.
So what does that actually buy? What does that multi-billion-dollar commitment look like on the ground?
It really breaks down into 4 key areas. First one is compute power.
The chips.
Billions more on securing the next-gen chips, specifically the NVIDIA B200s. And we're not just talking about a small upgrade here.
No, this is a leap.
It's a massive leap in efficiency. It's what you need for training these huge foundation models. Securing those chips is everything for cutting down training time.
And what about their own systems? I mean, they built Dojo themselves.
Correct. That's the second area.
Yeah.
A huge expansion of their own Dojo supercomputer clusters. We know they're scaling up in Texas and New York specifically. This is the brain power.
It's the engine.
It's the engine that digests all those billions of miles of real-world driving data to keep making full self-driving better.
Okay, that covers the software side. But what about the hardware? You've got Optimus, you've got the Cybercab. You can't just wish those into existence.
And that's the third and fourth piece. It requires an incredible amount of money. Optimus, the humanoid robot, is moving from a prototype to a factory worker.
Which is all about tooling.
It is purely a tooling challenge. So we're talking about massive investment in specialized assembly lines, new materials. It's a totally different manufacturing game than building cars.
And the Cybercab fleet.
The dedicated manufacturing lines for that have to be built out at the same time, so you add it all up. Compute, Dojo, Optimus tooling, Cybercab lines, and you see what they're doing.
They're building the AWS of real-world AI.
That's the vision.
Okay, but let me play devil's advocate. If they commit, say, $10 billion to internal CapEx, doesn't that burn through their cash and make them more vulnerable to a recession?
That's an excellent point about risk. And yes, it draws down the capital, but the bet is on the certainty of future returns. I mean, think about it. $10 billion is like the entire R&D budget of a traditional automaker for a decade.
All in 1 year.
All in 1 year, on infrastructure. They're giving up short-term cash for a massive lead years down the line.
So the goal isn't just about selling more cars later, it's about changing how the stock is valued today.
Exactly. If they announce a 10 billion plus AI infrastructure spend on January 28th, the stock fundamentally re-rates. It's not an auto company anymore.
It becomes a tech giant.
With a valuation that includes Optimus, the data, everything, not just car sales, it signals disruptive high-leverage growth.
Okay, so that's the rocket fuel high-growth strategy. But let's pivot to option 2, which is all about value and confidence, the safety net buyback.
And investors have been asking for this for a while.
Understandably.
For sure. When you have this much cash just sitting there, returning some of it to shareholders is a mature, standard move for a big tech company. It stabilizes things.
So what kind of size are we talking about, and how does it work?
The talk is anywhere from $5 to $10 billion. And the mechanism is simple. The company just buys its own shares on the open market.
But the implication is huge.
It's critical. It puts a mathematical floor under the stock price. It's management drawing a line in the sand.
So it's basically telling short sellers, go ahead, try it.
Exactly. It's a signal to the bears. If you push us down to, say, $400, we'll just step in and buy our own shares. They become their own biggest buyer.
And that confidence is huge for long-term holders.
Mm-hmm.
Plus, you're reducing the number of shares out there, the float. Isn't that the classic recipe for a short squeeze?
It absolutely is. You remove shares, the remaining ones become more scarce. So if any good news hits, the price can move up much faster, much more violently. It punishes the shorts.
We saw Apple do this, right?
We did, on a massive scale. It was a clear sign they thought their stock was undervalued. For Tesla to do a $5 or $10 billion buyback would be a monumental statement.
So you have this real tension. Strategy 1 is all in on future growth, on infrastructure. Strategy 2 is about guaranteeing value and supporting the price right now.
And that tension is what makes the January 28th announcement so fascinating. Which way will they lean?
Okay, let's talk about the third and maybe the most dramatic option. It feels less likely given their history, but a strategic shopping spree. Acquisitions.
Right. They rarely buy other companies. They prefer to build in-house. But now they have the cash to do something that was, unthinkable even a year ago.
What kind of targets would actually shock the market?
Well, one area that keeps coming up is mining. Specifically, lithium.
To control the supply chain.
Exactly. We've seen lithium prices go absolutely wild. Buying a major lithium miner would secure their supply for the next decade. It takes a huge variable out of their cost equation for batteries.
Not just for cars, but for that energy storage business that's exploding.
Precisely. Now, it's logistically very difficult. You're integrating a mining operation into a tech company. It's a whole different world.
A different culture, different skill sets.
For sure. But it offers incredible control over your costs.
Okay, what about on the tech side? If they want to speed up Optimus, where do they shop?
That's the other area. Targeted AI tech. They could buy smaller robotics firms with specific expertise, maybe in advanced manipulation or sensor arrays, things where they might be a little behind.
So you're basically buying time.
You're buying time and expertise. You get Optimus to factory worker status a year faster than doing it all with internal R&D.
And we have to talk about the elephant in the room when we talk acquisitions.
XAI.
XAI.
Absolutely. The leadership is shared. The goal of generalized AI is shared. The synergy is obvious. Now, they'll probably stay separate companies.
Right.
But a deeper investment or strategic partnerships that guarantee Tesla access to their models. That's definitely on the table.
So to wrap up the 3 paths, massive internal AI spending for growth, a big stock buyback for value, or a strategic acquisition in raw materials or AI tech.
And that really is the key takeaway for you listening. That delivery miss was just short-term noise. The real signal is the $41.6 billion in cash. That money is not going to sit still.
Whether it's on AI chips for growth or buybacks for value, that capital is going to work.
It's going to work for shareholders one way or another.
And for you, our listener, the date to circle on your calendar is January 28th. Watch for that post-market announcement on the 2026 guidance. That's when we'll know. Until then, the bulls are very much in control above that $430 level.
And this all raises one last question for you to think about. If they do go with strategy 1, the AI Manhattan Project, which is this huge bet on themselves, does that mean they know they're missing a key piece of the puzzle? I mean, can you really build the AWS of real-world AI without acquiring, say, a specialized sensor company or next-gen mapping tech?
Things that are really hard to develop in-house.
Extremely hard and time-consuming. So the question is, what missing piece might force them into a surprise acquisition that nobody sees coming? Something to think about as we wait for the 28th.